Hi everyone, this is Victor here. Welcome to the Intelligent Investor channel. At the time of making this video, Amazon stock is down 38% from the most recent peak. The Nasdaq is also in a large correction. The Nasdaq is down 24% from the most recent peak. In my opinion, most US tech stocks are undervalued now. If you're an investor, you may ask, is Amazon stock a value trap or is Amazon stock substantially undervalued now? I will answer this question in this video by talking about these topics. First, Amazon earnings review. I will explain why Amazon stock dropped as much as 14% right after its recent earnings release. Second, is Amazon stock a value trap or undervalued now? Third, Amazon stock valuation. You will learn about Amazon stock's intrinsic value and how to calculate it. And fourth, will I buy Amazon stock? If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and investing videos a week that will help you become a great investor. Also, if you like this channel and want to support it, check out my Patreon blog in the video description and become a premium member. Our goal is to create the best intelligent investor community that will help all our members grow their stock portfolios to over 7 figures over time. With your support, we'll be able to stay independent, hire other outstanding analysts to cover different stocks, and create many excellent stock analysis and investing videos a week that will help you become a great investor. The link is in the video description. Take a look, let's start. The first question you may ask is, why did Amazon stock drop as much as 14% right after its recent earnings release? There are several main reasons. The first main reason is that Amazon's revenue growth has slowed down significantly in the most recent quarter. This is from CNBC. Revenue at Amazon increased 7% during the first quarter compared with 44% expansion in the year-ago period. It marks the slowest rate for any quarter since the dot-com bust in 2001 and the second straight period of single-digit growth. This table here breaks down Amazon's revenue growth for each business segment. You can see Amazon's online store sales decreased 3% year over year. In comparison, Amazon's online store sales were growing double digits during the pandemic in 2020 and 2021. Amazon's online store sales have slowed down significantly in recent quarters because many customers are shopping more at brick-and-mortar stores again. This is why you can see Amazon's physical store sales actually increased 17% year over year. Amazon's third-party seller services sales grew 7% year over year. You can see its sales growth has slowed down significantly compared to previous quarters. Amazon's subscription services, which include Prime membership, grew 11% year over year. This business has also slowed down compared to previous quarters. Amazon's advertising services sales grew 23% year over year. This business, along with Amazon Web Services, should have the biggest growth potential and operating income growth going forward. Amazon Web Services (AWS), which is Amazon's cloud business, is the only business that has maintained a very high revenue growth rate compared to previous quarters. AWS grew 37% year over year in the most recent quarter. Amazon's operating costs have increased significantly in recent quarters because of high inflation rate around the world, overstaffing in Amazon warehouses, and excess capacity in Amazon's fulfillment network. Amazon's operating income dropped significantly in the most recent quarter because of much higher operating costs. For example, if you look at these financials here, Amazon's total sales were up 7% year over year. This is much lower than the double-digit revenue growth Amazon used to have in previous quarters. However, in the same period, Amazon's operating income was down 59% year over year. This means Amazon's operating costs grew at a much higher rate than its revenue growth. Amazon is a very capital-intensive business. The company has very high capital expenditures, capex, every quarter. Every quarter, Amazon needs to reinvest billions in warehouses, fulfillment centers, transportation networks, and infrastructures to support its online stores, Fulfillment by Amazon (FBA) services, and Amazon's cloud services. For example, if you look at this here, you can see Amazon's trailing 12 months of free cash flow was down 297% in the most recent Q1 quarter. This is from the most recent earnings call. It explains why Amazon's operating costs are much higher now. Labor and physical space are no longer the bottlenecks they were throughout much of 2020 and 2021. However, we continue to face a variety of cost pressures in our consumer business. We'll break this into two buckets: externally driven costs, primarily inflation, and internally controllable costs, primarily productivity and fixed cost deleverage. leverage. The externally driven costs are a result of intensifying inflationary pressures throughout Q1. For example, the cost to ship in overseas containers more than doubled compared to pre-pandemic rates, and the cost of fuel is approximately 1.5 times higher than it was even a year ago. Combined with the year-over-year increases in wage inflation, these inflationary pressures have added approximately $2 billion of incremental costs when compared to last year. While we will continue to look for ways to mitigate these costs, we expect they will be around for some time. The next bucket of costs related to productivity and fixed cost leverage, which we consider to be more within our control and are working to reduce. Let's start with labor. As a reminder, in the second half of 2021, we were operating in a labor-constrained environment. With the emergence of the Omicron variant in late 2021, we saw a substantial increase in fulfillment network employees that are on leave, and we continue to hire new employees to cover these absences. As the variant subsided in the second half of the quarter and employees returned from leave, we quickly transitioned from being understaffed to being overstaffed, resulting in lower productivity. This lower productivity added approximately $2 billion in costs compared to last year. In the last few weeks of the quarter and into April, we have seen productivity improvements across the network, and we expect to reduce these cost headwinds in Q2. The last issue relates to our fixed cost leverage. Despite still seeing strong customer demand and expansion of our FBA business, we currently have excess capacity in our fulfillment and transportation network. Capacity decisions are made years in advance, and we made conscious decisions in 2020 and early 2021 to not let space be a constraint on our business. During the pandemic, we were facing not only unprecedented demand, but also extended lead times on new capacity, and we built toward the high end of a very volatile demand outlook. Now the demand patterns have stabilized. We see an opportunity to better match our capacity to demand. We do expect the effects of this fixed cost leverage to persist for the next several quarters as we grow into this capacity. When you combine the impacts of the externally driven costs and the internally controllable costs, you get approximately $6 billion in incremental costs for the quarter. Approximately 2/3 of these costs are within our control, and with demand normalizing, we remain focused on right-sizing our cost structure and driving out any cost inefficiencies. Amazon's management gave very low revenue guidance for the next quarter that did not meet analyst expectations. Amazon's management said net sales are expected to be between $116 billion and $121 billion, or to grow between 3% and 7% compared with the second quarter of 2021. Operating income is expected to be between -$1 billion and +$3 billion, compared with +$7.7 billion in the second quarter of 2021. Another reason is that Amazon reported a very large unrealized valuation loss in Rivian stock. Amazon is a large shareholder of Rivian. Amazon has approximately 18% ownership of Rivian. Rivian stock has lost more than 70% of its market value since its IPO. Here's the very important part you want to know. Because of the fair valuation accounting principle, Amazon needs to report unrealized valuation gain or unrealized valuation loss on Rivian stock every quarter, even if Amazon did not sell Rivian stock. For example, in the most recent Q1 quarter, Amazon reported a very large valuation loss of $8.2 billion. Of this $8.2 billion valuation loss, $7.6 billion valuation loss was from Rivian stock because Rivian stock has dropped significantly compared to the previous quarter. Last year in Q4, Amazon reported a $12 billion unrealized valuation gain in Rivian stock because Rivian went IPO. In my opinion, it's much more important to focus on Amazon's operating businesses and operating income. Even if Amazon has a large valuation loss from Rivian investment, it does not affect Amazon's operating businesses. Here's the important question you may ask. Is Amazon stock a value trap or is Amazon stock undervalued? In my opinion, I believe Amazon is not a value trap because I believe the overstaffing and overcapacity problems, as I mentioned earlier, should only be temporary. For example, Amazon hired too many employees to work in their fulfillment centers in the second half of 2021. The main reason was that many employees went on leave in late 2021 because of Omicron variants. Now, many of them have returned to work. This is why Amazon's fulfillment centers have become overstaffed instead of understaffed, which means lower productivity and much higher operating costs for Amazon. In my opinion, it will take Amazon at least several quarters to solve this overstaffing and lower productivity problems. This should only be a short-term problem and not a long-term problem. Another issue is that Amazon invested too much to expand its fulfillment by Amazon FBA and transportation network during the peak of the pandemic in 2020 and 2021. At the time of making this video, management said that they have excess capacity in their fulfillment and transportation network. This means e-commerce demand still has not caught up with Amazon's increased fulfillment network capacity yet. The biggest reason for this excess capacity is that Amazon's e-commerce sales have slowed down significantly in recent quarters. Many customers are shopping more at physical stores again. This means there is less operating leverage for Amazon. This is why Amazon's operating income had dropped significantly in the most recent quarter. In my opinion, I believe it will be a matter of time before demand catch up to Amazon's fulfillment network capacity. I believe it will take Amazon at least several quarters to solve its overstaffing and excess capacity issues. I believe these operating leverage and overcapacity issues should only be temporary. These issues should not affect Amazon's economic modes and long-term prospects. This is why I believe Amazon is not a value trap. Another problem that is affecting Amazon is obviously high inflation around the world. This is outside of Amazon's control. At the time of making this video, high inflation costs such as high fuel costs, high transportation and shipment costs, high inventory costs, high food costs, high wages, and high stock-based compensations are all affecting Amazon's operating profit. The ongoing Ukraine war has caused fuel costs and food prices to increase a lot in recent months. Management is looking for ways to minimize these high inflation costs. For example, Amazon increased its Prime membership in Canada and the US to offset some of the inflation costs. Amazon also added a 5% fuel and inflation surcharge to its fulfillment services used by third-party sellers who sell their products on Amazon. This means many third-party sellers will likely pass this 5% fuel and inflation surcharge to consumers by increasing their product prices. Management said this. Inflation has been in both periods. Inflation was in the transportation costs, especially in wage inflation last year. It remains there. It's being amplified a bit by the fuel costs following the Ukraine conflict, which has happened since we last spoke, so it's more a factor. Those costs will now, we believe, will persist a little longer than we were hoping at the beginning of the year. And I mentioned some of the per unit rates for transportation, cargo shipments, and also fuel costs. Those are real, and we have to find ways to offset those or use less of high cost things like transportation and fuel. So we're working on that. So what's left there is really inflation, and that's what we're working on and evaluating and finding ways to mitigate, and in some cases having to pass some of the costs through to third-party sellers as well, so that we are not subsidizing sales there. And then we will see. So we expect the year-over-year revenue comps to improve in the second half of the year because, again, we're passing this year of super high growth that I mentioned before from May of 2020 to May of 2021. But it's not like the volume has receded, like in Q1 literally, where revenue 61% higher over 2 years from 2020. So the way to think about it went up and stayed up, and now it will resume a more normal growth pattern. On the positive side, Amazon's cloud business, Amazon Web Services, AWS, is still growing at a very high double-digit rate. AWS is Amazon's most important business because AWS has the highest revenue growth rate. And more importantly, AWS contributes the most operating margin to Amazon. For example, in the most recent quarter, AWS revenue grew 37% year over year, which was the highest growth rate compared to other businesses. AWS contributed $6.5 billion of operating income. In comparison, Amazon's North America and international segments had large operating losses. This means most of Amazon's operating profit is from AWS and not from e-commerce or third-party seller services. Also, according to the latest data from Synergy Group, AWS had the largest 33% market share in the cloud infrastructure services market in Q1 2022. AWS has been the market leader in infrastructure as a service and platform as a service markets for many years already. The barriers to entry into the cloud market are extremely high. The three largest players, Amazon Web Services, AWS, Microsoft Azure, and Google Cloud Platform, already dominate the cloud infrastructure services market. In my opinion, it will be almost impossible for the new companies to compete with them in the same markets. Management said this showing there's an enormous backlog and demand for AWS services. Just on the backlog, so yes, we're continuing to see what the backlog is, right? It's the increase of AWS customers making long-term commitments for AWS. As the March period ended, we had 88.9 billion balance for that, so that's up about 68% year over year. And the weighted average of remaining kind of lifetime for those is 3.8 years. Let's calculate Amazon's intrinsic value so we'll know whether Amazon stock is currently undervalued, fairly valued, or overvalued now. I always use this intrinsic value calculator to calculate a stock's fair intrinsic value. If you want this calculator, you can download it in my Patreon blog in the video description. We're not using a discounted cash flow DCF model to value Amazon's intrinsic value because Amazon does not have consistent free cash flow growth yet. Amazon has many businesses, so it's much better to use the sum of the parts valuation model to estimate Amazon's intrinsic value. Amazon's major businesses are Amazon's online stores, physical stores, third-party seller services including Fulfillment by Amazon, subscription services including Amazon Prime, advertising services for third-party sellers, and Amazon Web Services (AWS). Let's go over each business segment here to find out their fair intrinsic values. Amazon's online stores and physical stores had total value of $238 billion in the most recent 12 months. The two comparable companies are Walmart and Target. We're using their 5-year average price to sales ratio here, which is 0.7. If we multiply $238 billion of revenue here by the average price to sales ratio of 0.7, the combined fair value is $167 billion. Amazon's third-party seller services had total revenue of $105 billion in the most recent 12 months. The two comparable companies are eBay and Alibaba. The 5-year average price to sales ratio is 6.16. If we multiply $105 billion of revenue here by the average price to sales ratio of 6.16, the fair value is $646 billion. Amazon's subscription services had total revenue of $33 billion in the most recent 12 months. The two comparable companies are Netflix and Spotify. The 5-year average price to sales ratio is 6.61. If we multiply $33 billion of revenue here by the average price to sales ratio of 6.61, the fair value is $215 billion. Amazon's advertising services had total revenue of $33 billion in the most recent 12 months. The two comparable companies are Alphabet and Facebook. The 5-year average price to sales ratio is 8.27. If we multiply $33 billion of revenue here by the average price to sales ratio of 8.27, the fair value is $270 billion. Amazon Web Services (AWS) had total revenue of $67 billion in the most recent 12 months. The two comparable companies are Microsoft and Oracle. The 5-year average price to sales ratio is 7.25. If we multiply $67 billion of revenue here by the average price to sales ratio of 7.25, the fair value is $486 billion. At the time of making this video, Amazon has $66 billion of cash equivalents and marketable securities, and $264 billion of short-term and long-term debts. This means the net debt is $198 billion. If we add each business fair value here and minus the net debt, Amazon's intrinsic value should be $1.6 trillion for the entire company, or $3,118 per share before the upcoming 20-for-1 stock split. Just to compare, Morningstar gave Amazon a much higher fair value of $3,850 per share. This means I believe Amazon stock is likely undervalued at the time of making this video. Here's the asset test. Will I buy Amazon stock? My answer is yes. I will continue to buy more Amazon shares whenever the stock becomes substantially undervalued. I already have Amazon stock in my portfolio here. I will likely buy more Amazon shares going forward because I believe the overstaffing and overcapacity problems are only temporary. I believe Amazon's e-commerce business will eventually recover once inflation is much lower. Based on my estimates, I believe Amazon's intrinsic value is around $3,118 per share. I will update Amazon's intrinsic value every quarter whenever it releases its earnings. If you want the latest intrinsic value update, you can download it in our Patreon blog in the video description. Now, all these estimates are only my opinions and my analysis based on my research. They are not financial wise. There are always risks associated with investing. It's important to always invest in what you know and not speculate. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.